Hello, everyone. Thank you very much for joining us today. I would like to begin our 10th masterclass. The topic for today is Boost Your Revenue with AI Powered Digital Credit. And as usual, as we begin our session, we would like to request all of you to mute your phones during the session. And if you do have any questions, please post them on the WebEx chat and we will respond to them at the end of the session. And we have John Selleck, our order to cash process expert. He's a speaker today for us, and he's going to take us through his wide range of experiences, knowledge, share his knowledge and insights with us. John comes with over 3 decades of proven performance and a broad range of experience in industries with over 250 clients. And John, I would like to not hold you further along and then wanted to just pass it over to you to get started with our masterclass for today.
Great. Thank you all, Shay, and welcome everyone. It's a pleasure to be here with you today. And again, we have, I think, a very thought-provoking topic here, designed to look at things maybe a little differently than you have in the past, and identify some opportunities for you and your company. So, talking about boosting revenue, and we'll start off by talking about the current revenue challenge, which most companies are facing. And we'll talk about creating a competitive advantage in credit. And maybe you never thought about that before, but it's real. And we'll talk about how it can help you and help your company. And then, of course, we'll talk about the solution, heavily revolving around artificial intelligence powered digital credit. We'll give you review quickly a case study, customer success story, talk about the benefits available, wrap it up with a conclusion, and then answer any questions you may have. Revenue challenge. This is probably familiar to most of you. For most companies, this COVID economy has done two things. One, reduce revenue, but also raise the overall level of credit risk. So, looking at the first thing, the reduced revenue, a knee-jerk reaction would be, well, revenue's down. We need to make it up as best we can. We need to sell our way out of this. So let's sell whatever we can to whomever we can, as much as we can, and make the best of it. Well, if you do that, and a lot of your customers' financial strength deteriorated in this economy, you're going to run into two problems pretty quickly. One is the cash flow, as these customers are unable to pay you full amounts or on a reasonably timely basis. And then some will never pay you. So you're looking at a looming bad debt hit. So you need to more, you need to control credit better. These look like two conflicting imperatives. So what can a company do? Well, there's a number of things. But one part of the solution, which we'll focus on today, is maximizing sales to new customers. And those that have, but the right new customers, the ones that have reasonable financial strength and are tolerable credit risk. Now you'll notice I put both of those terms in quote marks because what is reasonable and what is tolerable? And the answer is it's very individual company dependent. What's reasonable and tolerable for one company is probably not for another. So it depends on your individual situation. How severe has the revenue drop been? How severe has the economy weakened your customer base? But another key factor here is the gross margin of the product or service that you're selling. If you're fortunate enough to have a high gross margin, then, if you look at the sales to new customers in total, even if a couple of those customers go out of business and never pay you, you'll still make enough money with a high gross margin on the sales to the other new customers to compensate for that. So net, you'll probably be ahead of the game. However, if you have a low gross margin and one or two of your new customers go out of business and never pay you, it's going to take an awfully high volume of sales at a low gross margin to compensate for that profit loss. So those are some of the key factors. Again, it's very individually determined, and again, should be defined and articulated according to your company's trade credit strategy. All right. So now here's a revenue opportunity with new customers. How can you create a competitive advantage? Well, clearly by having the best product or service. But beyond that, what can create a competitive advantage? And certainly selling to new customers is not a new concept. Probably most of your competitors have reinvigorated their effort to secure and sell to new customers. So they're going to be doing the same thing. So how can you beat them? Well, one way, one advantage is the fast onboard of a new customer. And because once you onboard a customer and you're supplying them with your product or service and you're doing that well and they're happy, most companies don't like to onboard additional suppliers in rapid succession. There's a certain amount of administrative work and, they want to, in procurement, they want to spend their time evaluating the performance of the new supplier, meaning your company, before they move on to another one. Now, if you're doing a lousy job, they'll move quickly to seek out additional suppliers. But if you do a good job, then it becomes a much less urgent task. If you can get into a new customer quickly and do a good job, in many cases, you'll preempt the competition. And that's a competitive advantage. And a key part of the onboarding process really starts with the credit vetting. You're going to sell to them on credit or not? And if so, how much? Because if you don't sell to them on credit, they probably won't come aboard. They'll look for a supplier that will. But reaching that credit decision fast, and if it is positive, credit, and then proceeding with the remainder of the onboarding tasks quickly, get you up and supplying them, and again, puts you in a real good position and gives you a competitive advantage. So we say fast. Let's do the credit decision fast. Well, how fast is fast? Well, Hackett, with their world-class performances, say it should take 2 days, which is fast. That an old saying, speed kills, which was a traffic safety phrase popular years ago. Well, it does here too, and it kills the competition. So that can be a creative advantage, competitive advantage, that can be used to your benefit. How do you do that? How do you create that competitive advantage? How do you onboard customers fast? Well, we're focusing on the credit decision and the need to do that quickly. And the solution that we feel is absolutely essential is artificial intelligence powered digital credit. And what is the technology of this solution? Well, first of all, AI, artificial intelligence, with the cognitive and self-learning features, natural language processing. This ability to interpret different types of text from different sources and voice as well is very valuable, because that information is not, credit information is not really standardized. So there's a lot of variability there. You need to be able to cope with it. And then certainly integration with your ERP. That's the control mechanism, the system of record. And then AI empowers and enables digital assistance. And this is really important. And this is where a lot of the benefit comes in. So let's take a minute here. What are digital assistants and what do they do? Well, to it progressively in a little more detail, but at a high level, they assist your workforce and as well provide information to management on kind of a Siri basis. Our receivables today. The digital assistants can answer that question. Also, it engages and assists with customers around the clock, 24/7. And this is particularly important when you're dealing with the small and medium-sized business segment. Very often they're unable to handle and address their administrative tasks during what we would call normal business hours. So they do it nights, weekends, that sort of thing. And having the ability to interact and assist them 24/7 is a big advantage. And then lastly, but not least, digital assistants perform repetitive tasks. And we'll give you some examples of that here in a minute. And ultimately the benefits is that fast credit decision, which is the major point of our masterclass today. Automation of 70 to 80% of the manual tasks in credit vetting. That's huge. I mean, how many processes do you have that you manage where you can reduce manual effort by 70 to 80%? Not many. And that's a huge benefit. And then ultimately leading to better credit decisions. So let's probe a little deeper here on benefits of this solution. Major one is time saving, and two dimensions to that. One is the actual work time spent on these tasks, but the other is the elapsed time. Remember, we want to get to that credit decision in 2 days, or maybe 1 day, if you can do it. Powered digital credit and make impacts on both these dimensions of time. Some examples. But also securing the credit app, right? If you think of the old days, some of you might still be using a hard copy credit app or some sort of Excel or Word document that the customer gets, completes, sends to you in a PDF file, something like that. If working with that, there's the potential for a lot of back and forth, right? So the customer completes it, sends it to you, and you look at it and you see, oh, they forgot to fill out lines 5, 7, and 9. Well, you send it back to them, please fill out 5, 7, and 9. And they send it back to you and they fill out 5 and 7, but not 9. So you got to go back to them a second time. Hey, please fill out line 9, in nicer language than that, of course. And but this back and forth, one extends the elapsed time, sometimes seriously, and two creates a lot of excess wasted work time. And the beauty of an online credit app is the potential customer cannot submit it unless it's completely filled out. So you fill it out, you miss a line or two, you go to submit, get an error message, can't submit. Please fill out line 9. So that eliminates a lot of this back and forth in just getting the credit app. And of course has electronic signatures, so that speeds and facilitates things as well. And the next thing AI will do is automate the gathering of information. Get the bank and trade references, data from your credit bureau, whether it's D&B, Credit Risk Monitor, Experian, whichever one you use. So now you're assembling the data to make the credit decision, and you're doing it fast and with virtually no labor. The other key thing a digital assistant will do in credit is verify key information. So does this customer have a valid business license in force? Do they have a sales use tax or a VAT certificate that's valid and again has not expired? Always a big problem. OFAC, the prohibition on selling to suspected terrorist organizations. Is this company on the OFAC list? Nice to know. So you don't want to violate those laws. confirm the legal address, legal name, things like that. So all necessary tasks that can be quite laborious if it's done on a internet search ad hoc basis. And then automated scoring with parameters and weighting that you specify, and leading to a recommended credit limit. Now the credit manager can say, well, I want a different credit limit. I want to raise it. I want to lower it. But whatever, it's presented to them with a rational logic behind it. Because then the actual decision is quick. If you think about credit vetting and credit decisions, the time is spent, both the work time and the elapsed time, in getting the credit app completely filled out and gathering the information to make the credit decision. An experienced credit manager generally can make these credit decisions pretty quick. And that's where 80% reduction in manual effort comes from. So very powerful, very useful, and certainly instrumental in being able to turn around a credit app in 2 days or less. Let's go just one more level deeper here on how it works and some of the digital credit enablers. Alluded to this early, an online credit app, but it's customizable. So you frame it as you wish. For example, let's take the example of a credit manager who really doesn't place much value in trade references. You figure, well, this applicant's only going to give me trade references that are going to give them glowing reports. So, why bother? Okay, no, leave that off your credit app. And again, it can be completed and signed and submitted online. The automatic real-time import of the credit information. And again, we're talking about onboarding new customers fast, but certainly this also plays a nice role when you're updating the credit limit of existing customers, because you can import their payment history, which, as we know, is a big influence on evaluating the credit limit of existing customers. Automated credit scoring, and again, customizable. So going back to that credit manager that doesn't put much trust in trade references, you can either eliminate the trade references or give them a very low weighting in the overall credit scoring. Then with the AI, you can make credit decisions, again, based on the rules, criteria, weightings that you've supplied. And then realizing that higher credit limits are going to require additional authorization signatures up the financial chain. AI digital credit comes with a full-featured workflow to secure those approvals according to your delegation of authority policy. Again, our focus is on onboarding new customers, but for existing customers, this whole process of updating credit limits once a year, every other year, which is probably more frequently now, that can all be automated. There's a nice automatic order hold capability, which is a key tactic in managing credit risk and also driving collectors. I mean, I've had clients, when you ask them what their collection strategy and prioritization and all is, and basically all they do is they just work the credit holds. They have low credit limits and tight delinquency triggers for an order hold, and just work them all day. And so that's a critically important function as well. And then, to get the big picture for the credit manager, configure credit scorecard. We want to do credits, make credit decisions in 2 days. Well, how are we doing? Scorecard will tell you. What's the backlog? How old is the backlog? And then also importantly is analytics, so you can kind of score the whole AR portfolio. How risky is it? Very important in these days, because probably the risk has gone up, and nice to be able to track it, keep your finger on the pulse and see how much it's gone up and how fast. And is there something you need to do? A lot of functionality here, a lot of power that certainly speeds up the process, reduces the manual work, and also leads to better credit decisions. So here's a customer success story. Company that sold building materials into the domestic U.S. market. Now, in the U.S., the contractors, construction companies have very limited financial resources. The nice phrase is thinly capitalized, and that's being polite. Very thin on any kind of resources. I mean, they get paid once a month by the general contractor, and then they pay their suppliers. And that's, if you're lucky, you get paid. So they need vendor financing, supplier financing. And, you know, this company was willing to do that, but they wanted to certainly manage the credit risk. And they had manual systems up with it from either a quantity or a quality perspective. So they the Emagia digital credit automation solution, which had the features we talked about that, specifically here, the digital credit app with the digital signatures. Their inputs were primarily Experian, had a NetSuite analytical tool to facilitate the credit limit computation. Here, the resale certificate verification was very important. And again, automated about 80% of the process. Now they're able, since they're growing rapidly, they're able to keep up with the vetting and onboarding of all these new customers who are very key from a credit standpoint, but still able to do business. So let's just take a quick look, recap the benefits here. Remember, we talked about creating a credit competitive advantage. We talked about part of the solution to dealing with this economy was to sell to new customers, generate that new source of revenue. And key element of that is the fast turnaround of credit apps, onboard that customer quickly, preempt your competition. Certainly the increased productivity. If you think about a credit department these days, not only they have new customers, but with the credit worthiness of their existing customer base deteriorating, in many cases having already deteriorated, and probably going to deteriorate more over the next year. There's a much higher workload with re-evaluating the credit rating of existing customers. So you got a higher workload. How are you going to cope with that? Nobody wants to hire more people, particularly if your revenue's down. So that increased productivity is very important and enables a company to maximize its revenue while controlling credit risk in a down economy where credit risk is elevated. Now, notice we're not saying eliminate credit risk. We're saying controlling it. That's the best you can do. And if your customers, if there's a fair volume of e-commerce orders, you know, with e-commerce, customers are expecting that order to be approved, processed, fulfilled quickly. The fact that they may be a new customer and not established a credit limit with you, you know, they still expect it fast. So this gives you the capability to, again, quickly vet and onboard new customers and fulfill those orders quickly. And ultimately, it enables you to meet the challenge of managing in a higher credit risk environment, but also new sources of revenue. So you see the chain here at the bottom, customers at controlled credit risk, better cash flow. Ultimately, that's going to give you increased revenue and profit. So, you know, just to wrap up here, conclusion, the impact of the economy on credit risk and revenue and credit department workload, and how the credit risk management functions and processes need to be faster and have much greater capacity. And certainly the AI-powered digitization features and functionality that we just reviewed is a key way to supply that. I mean, improving internal processes, that'll help, but not the leap forward that this economy and its challenges require. Questions?
Thank you very much, John. So before we get to the questions, just wanted to again remind everybody over here to post your questions in the chat window to the host, and we'll take them up. So, John, the first question that you have is how do you define a reasonable financial strength and a tolerable credit risk for new customers?
Well, I touched on that a little bit before. And so, let's take them one at a time. Reasonable financial strength. What's reasonable financial strength? Well, again, it depends on your individual company's trade credit strategy. You're going to be real tight on credit and preempt delinquency and bad debt issues, or you're going to be more aggressive, be a little more liberal with credit, assume higher levels of credit risk, and hope that the increased revenue and the profit you make from that increased revenue offset the increased bad debt and the slower cash flow that may very well result. So that's once you articulate where you stand on that strategy, then defining a reasonable financial strength and a tolerable credit risk becomes a lot easier. And it varies by industry, and it varies by company. I mean, I've worked with clients in industries where they got a new credit manager, and the credit manager came from an industry where most of the customers were financially very strong, paid time, defaults were very, very rare. And they go to a new company where the customer base is thinly capitalized. And they say, well, look, if I was at my old company, I wouldn't sell on credit to any of these customers. Well, then you don't have a business, So that's why it varies so much by customer, by company.
Thank you, John. Thank you very much for that. The second question that we have is, why do you say the actual credit decision is quick and does not require much time?
Well, you get a credit manager with any level of experience. They've done a lot of these. Generally, the credit information that's available out there is good. And so once you've got the information, an experienced credit manager can usually make a decision very, very quickly. Now, where there's new customers, where the information is sparse or the information's unreliable, like credit reports from Angola, much do you trust them? Then it takes a little longer. But for most of the credit decisions, an experienced person can make those pretty quickly.
Thanks, John. I think this is going to be, we just have one more minute to go. This is going to be our last question. Does the automated verification of basic legal information about a customer really saves a lot of time?
It does. It does. Because remember, these systems that do this auto verification, first of all, they already know where to get it. They know which agencies, government agencies, have that information, where they are, their web address, their email address, all that sort of thing. So they can go and get that information pretty quickly. Certainly in the United States, it varies by the 50 states and territories. And in some cases, the information varies by the 3,100 different counties within the United States. So where do I go to get this information? It takes some time to set that up. And the same thing overseas. You're looking at Europe. Where do I get this information? Well, by country to start, and that adds complexity. So that's one way they cut the time, and the other is just by doing it one automatically, so it saves human time and makes a big contribution there.
Thank you, John. I think we are at the top of the hour, just past 1 more minute to our scheduled time. So just wanted to request everybody, want to thank you all for joining us today. And our next masterclass is on 11th of February, which is going to be Thursday, again at 10 a.m. Pacific. And our topic is going to be enhance your customers' experience with real-time payments. So we look forward to seeing you out there. We have the link over here mentioned on the chat over here. You could basically go and send us an email or register on our website for booking your seat for this session. And we look forward to, again, meeting you on 11th of Feb. Thank you very much.
Thank you, Akshay. And we do welcome questions, so please don't hesitate.
Yeah. Thank you very much. Yeah. If you do have any questions, feel free to write to us at info@emagia.com. Thanks for reminding that, John, about that. Yeah. All right. You have a very great day ahead, all of you. And thank you very much, John. Take care.
Thank you.
Bye-bye.